Welcome to Hand Rolled Real Estate. I'm Robbie. I'm here with Jay. Uh, we're very passionate about cigars and real estate. And today we're smoking a Tatawahe Limited, and we're going to kind of talk about maybe some of the cracks happening in the foundation of real estate investing.
Couldn't have put it better, Robbie. Welcome, everybody. I'm Junaid Noor, and welcome to Hand Rolled Real Estate. Yeah, this week, Arbor Realty foreclosed on another multifamily property in Houston. This one near Greenspoint Mall up in Spring. I believe it was a 372 unit complex built in 2008. And it says public records showed that it was owned by Inman Equities, a Nashville-based equity real estate firm led by Benjamin Inman. And, Arbor uh, has foreclosed on another one earlier this quarter, actually, earlier last quarter, which the details are very private. They sold it to somebody who was an ex-vice president of origination for Arbor, but they foreclosed on another one. They sold it as a short sale, and now Arbor's got this one. And I think this is just the beginning.
Just to kind of clear up what Arbor does, what exactly do they do in the multifamily market?
So Arbor's a lender. They provide um, loans. We have contacts with people at Arbor. They're out of New York, and they provide loans for multifamily. And they have all kinds of different loans. They have agency loans, which are the loans that are backed by Fannie Mae. Fannie Mae, FHA, HUD, and then they have the CMBS, collateralized mortgage-backed securities. They have those loans available as well. And so there's a lot of different products that they have available. And they made a lot of loans during the heyday of the multifamily back in what, 2000 and 2022? 2022.
Yeah, and they're so they're actually taking this back from the originator of the loan, and I guess they're going to try to sell this back out there in the market. And we don't really know any details. We don't know if it's a mismanaged property. We don't know if it was a resetting of a loan that killed it. But we don't have a lot of details. But these are things I think that are on the horizon for us as a lot of these loans reset. And some of the I think some of these groups that got into this multifamily value add, they may have been financially savvy and been able to put these deals together, but managing these properties after the fact and continuing and ongoing maintenance and things, and now they're resetting these loans at a higher interest rate. If they didn't do everything the way they were supposed to, they may be paying the price now.
Yeah, the issue becomes, and yeah, we don't have a lot of detail on why Arbor did this. Arbor also took over six properties from Apple's Way Investment last year. It made all the headlines. They foreclosed on six pieces of property. A lot of these properties were very low debt service coverage ratios. They were barely making, 1.05. They were on, variable interest rate loans. And then even if they had rate caps, if you bought a rate cap in 2022, it would have expired already. So with no rate cap, with low debt service, with mediocre management, there's not a lot they can do if they can't make their loan payments then.
Yeah, I know, and I know we've had some conversations about, some of the deals that we've looked at in the past, and they're going to manage these deals themselves, and you know, what qualifies them, and is that a better route to go than hiring a management company? And I think those are some challenges that are going to be put out in the forefront for a lot of these equity groups that acquired these multifamily properties.
Yeah, and hiring a management company is not a bad idea, but we had a friend of ours who bought a lot of property. He bought almost 3,500, 4,000 units within a span of 2 years. And that's what he was complaining about, is that the management companies don't do what they're supposed to be doing. And I think everybody knows that. But the asset manager in the ownership in the GP's corporate structure. Basically, they if the responsibility to execute the business plan falls on the asset manager. That's their job, and to make sure month to month rents are being collected, expenses are in line, distributions to stakeholders are being made, and if there's anything coming up on the horizon, like there's a large maintenance item that's coming up, they're prepared for it. They have the cash reserves available. So it's a business at the end of the day. It's not just, again, to me, what was happening in 2008 with residential properties is kind of what was happening in multifamily properties in 2020, 2021, 2022, which is we're going to buy this, we're going to renovate 10, 15, 20 apartments, prove up that the rent can go up, and then we're going to sell it to somebody else for a higher price and exit out. And this is exactly the mistake that a lot of homeowners or investors made in 2008. It doesn't matter what the cost of the property is. We're going to renovate it. We're going to hold it. Prices are always going to go up. We're going to get out. Problem was, when the music stopped, a lot of people got stuck with a lot of chairs or no chairs.
Yeah, yeah, no doubt. And I think as time goes on, the the sponsors and GPs that understand how important the management side of the property is, those guys are going to come out on top of this because, you know, for a few years it was a really I don't want to say loose, but I mean there was a lot of money being spent, a lot of deals getting closed, and now that the interest rates are tightening up or have been high and difficult to deal with, then here particularly in the Houston market, we had the escalation of insurance. They've had to deal with that. It may have slowed or stopped any distributions that you had coming in these as a passive investor. And now the guys that really understand the management. I mean, we've had several conversations. When do you evict a tenant? When do you, just something as simple as, oh, we need to get our rents. We've projected a 3% increase and we haven't done that yet. When do we do that? When do we roll that out? And just paying attention to all those details really pays big dividends in the end.
Yeah, no, absolutely. My other question is that when you have people like Arbor Realty, and again, I don't know the specifics of this loan, of this deal, of why they defaulted, the sponsors defaulted on the property, but I know for a fact from a lot of the underwriting that I looked at for deals that were happening at that time, people were projecting 10 and 12% rent growth every year for 5 years. And I'm wondering, when you have the sponsors are projecting this, which I think is a little too aggressive, but how is it that the banks didn't catch that? Why did their underwriting let that go and say, hey, wait a minute, even if we've had 13 and 14%. We had anywhere between 12 and 15% rent growth in the Texas market, depending on the geographical submarket in the years right after COVID. But that was it. If you look at a historical timeline, Texas has always been growing at around, 2-3%, 2-3%.
Yeah, and I think part of the um, thing that came into play that it might have surprised me a little bit. I don't know if it surprised you or others. Is the escalation in property value as a whole in the Houston market. Historically, Houston's kind of been a more affordable place to live, especially when it came to housing. And then, man, I think this last rush really kind of. I mean, we didn't get caught up with the rest of the country, but we definitely made a lot of ground up. A lot of a property appreciation was helping these guys get this money.
Yeah, and a lot of it has to do with people moving into Texas from different locations for whatever reasons. You know, a lot of it was because housing was much more affordable. You can get a much bigger house. COVID kind of changed the way people live, right? And what a lot of people decided to do was that, hey, you know, if we can work from home, then why not move to a place like Texas or Montana or Iowa where we can get a much bigger piece of property. And who knows? What if another pandemic hits and everybody's got to work from home? At least we have space to be able to spread out. So a lot of these people went and started buying homes um, in a lot of these different states where housing was affordable. But the other thing that's driving Houston and Austin and Dallas and San Antonio to a certain extent is jobs, right? Corporations are moving here. So when corporations move, then you're going to start getting people moving here too because that's where the jobs are.
Yeah, 100%. I mean, and we all know we've talked about the housing shortage and all those things, and those out of state influences when they moved in, uh, they had more money from the sale of their previous home, to put into the Houston market, and they were basically they were removing a unit off the market. Whereas if someone from Houston moved within Houston, they bought a house, but they sold a house, right? So it was kind of a net zero onto the market. Whereas all these people that came from outside of Houston and Texas, they were negatively impacting the demand or the
Yeah.
supply. Sorry,
Yeah.
and so it was definitely a strain on the Houston real estate market.
Yeah, and then in the next episode, we're going to talk a little bit more about the supply and demand numbers uh, in the geographical areas within Texas and then within nationwide. But getting back to the tip of the iceberg, I think there's a lot more properties that are going to come up to multifamily properties. They're going to come up for foreclosure, and there's only three things that a lender can do with the property once they start getting into not payment or default scenario. Number one, either they foreclose and they take the property, which a lot of lenders don't want, right? They're not equipped to manage multifamily properties. Number two, they're going to restructure the loan terms and they're going to work out some kind of a scenario with the owner of the property so that they can maybe reduce the payments. Now, with higher interest rates, the only way you can reduce the payments is turn that 20-year loan, amortize that loan from 20 years to 30 years, you know. And this way, the interest payments are still the interest rate is still the same at 8-9% right now, but those payments will go down. However, you know your balances are not going to go down, your principal balance is not going to go down, and that big that the big exit event that all these multifamily GPs look for, the exit event is we're going to either refinance the loan and cash out and pay everybody their returns, or we're going to be able to sell it. And then when you sell it, you got to pay down your existing mortgage, your principal balance, which is going to be much higher. That means that the returns at the end are going to be much lower. So those are the only three scenarios that lenders have at their option.
Yeah, and I think there was just a variety of hurdles or cracks that that these sponsors and GPs had to avoid. Resetting your loan at a higher interest rate, maybe even restructuring your deal, like what you're talking about. Let's restructure the deal, which may impact distributions. May accrue a lot of payments until the exit. Then you had the insurance, and now the guys that are going to shine are the guys that really understand how to manage these units and grow them, from within, create new opportunities within the existing property, whether it be covered parking, whether it be a dog park or whatever to generate to maybe help close some of those gaps. But I think you're right. I think there's going to be some opportunities for groups to maybe find some distressed properties and maybe capitalize on that.
And and this is from personal experience, right? We are talking to a GP sponsor, and we can't give the details of this deal because it's a 506B deal. Um, but we are talking to somebody. We're working with them actually, and they are in a scenario where they are picking up a multifamily deal for almost 30% below market value. In this scenario, what happened was that the bank has some of their existing loans, and the bank had this loan which they were going to foreclose on. And so the bank just approached them and said, "Hey, would you guys like to, you guys have a good operation, you know what you're doing. We'll take a bit of a discount, and would you like to take over this property?" And well, the bank is not actually going to take the discount. The owner is going to lose some equity. And then the owner was also an older gentleman who was just like, "I just don't want to do this anymore. It's a great piece of property, and once we close on it, we'll give some more information on it." But yeah, this is a scenario. 30% below market, and again, market is kind of sketchy, right? Deals. There have been no deals in Houston in the last 2 years, year and a half. So market is basically what sold 2 years ago. Um, and since nothing's been sold, there's no new baseline established. But 27% below what the last deal was, and then the owner's going to lose some equity on it as well.
Well, everyone, I hope you get to avoid the cracks and, maybe even jump on a really good deal or a good opportunity from someone else's misfortune. Grab a Tatawahe Limited, maybe allow about an hour and a half or 2 hours to smoke this beast, but it's a really good creamy smoke with maybe a little hint of cocoa. Really enjoying it so far.
Or you can also take advantage of uh, some of these cracks that are appearing in the market. And if you have the means, John D. Rockefeller had said that fortunes in America are made in land. And there's another quote which I had read which said that fortunes are made in the construction and destruction of society. So basically meaning when things are going down, you can make a fortune, and when things are going up, you can make a fortune. But it all has to do with real estate.
I hope you all enjoyed this episode. Looking forward to seeing you on the next one.